Imagine you live in Manchester. You earn pounds. Your rent is in pounds. Your groceries are priced in pounds. Your bank account has never held a single US dollar. Now imagine a decision, made thousands of miles away in Washington, changes the value of your currency, the cost of imported goods, the price companies pay to borrow, and eventually, the pressure on your own household budget. At the same time, a factory in Vietnam is buying equipment from Germany. An airline in Brazil is financing aircraft. A bank in Singapore is moving money between clients. A central bank in Asia is deciding where to keep billions of its country's savings. Different countries, different businesses, different currencies. And somehow the dollar keeps appearing. That is the strange power of the US dollar, not because every country has been forced to use it. Not because there is a secret room where governments agreed that America would control the world's money. And not because of one magical oil agreement. The real explanation is more interesting. The dollar sits at the center of a financial network that has spent decades making itself harder and harder to replace. And once you understand how that network works, something uncomfortable becomes clear. The dollar is not powerful, simply because America is powerful. America is also powerful because the dollar is powerful. As of the first quarter of 2026, the US dollar represented just over 57% of the world's allocated foreign exchange reserves. The euro was around 20%. The gap is enormous. And in the global foreign exchange market, the dollar is even more dominant. In the Bank for International Settlements 2025 survey, the dollar appeared on one side of 89.2% of all foreign exchange trades. The 10 most heavily traded currency pairs all involved the dollar. Think about what that means. When two currencies are exchanged somewhere in the world, there is an extraordinary chance that one of them is the American dollar. But here is the first important distinction. Being the world's dominant currency does not mean most people carry dollars in their wallets. It means the dollar performs several jobs at the same time. Governments save in it, banks lend in it, companies borrow in it, businesses price international trade in it. Investors buy assets denominated in it. Currencies are frequently exchanged through it, and when financial markets become frightened, institutions around the world often scramble to obtain it. That combination is what gives the dollar its extraordinary influence. To understand how it happened, we have to go back to a moment when the world's financial system was being rebuilt, almost from scratch. It was July 1944. The Second World War was still raging, but representatives from 44 countries gathered in Bretton Woods, New Hampshire, to design a monetary system for the world that would follow under the system they created. Participating currencies were linked to the US dollar. While the dollar itself was linked to gold at $35 an ounce, America had emerged with enormous economic strength and large gold reserves. The dollar became the central reference point of the system. If another country trusted the dollar, and the dollar could be converted into gold under the agreed system, then holding dollars made sense. A global habit was beginning, but then came the moment that should have changed everything. By the late 1960s, there were more dollars held abroad, and growing doubts about whether the United States could continue converting them into gold at the promised price. In August 1971, President Richard Nixon suspended the dollar's convertibility into gold. The foundation of the old system was gone. The dollar was no longer backed by a promise that foreign monetary authorities could exchange it for gold at $35 an ounce. So here is the mystery. Why didn't the dollar collapse as the center of global finance? Why didn't countries simply choose something else? That question reveals the real source of reserve currency power. By 1971, the world did not need the dollar. Only because it could be exchanged for gold, the world had built an enormous amount of financial plumbing around the dollar. Banks already used it. Governments already held it. Businesses already invoiced trade in it. Markets already priced assets in it. Investors already trusted American financial markets. Changing that entire network would be far more difficult than changing the rule about gold. And this is where money begins behaving a little like language. Imagine that you are organizing a meeting between people from 10 different countries. Nobody is legally required to speak English. But if English is the one language almost everyone already understands, it becomes the easiest language to use, and the more people use it, the more valuable it becomes for the next person to learn it. Currencies can develop the same network effect. If international banks already operate heavily in dollars, companies have a reason to borrow dollars. If companies borrow dollars, investors have a reason to own dollar assets. If trade is invoiced in dollars, businesses need access to dollars. If businesses need dollars, banks need dollar liquidity. If banks need dollar liquidity, central banks have a reason to maintain dollar reserves. And every new layer strengthens the others. The system reinforces itself. That is why replacing a dominant global currency is not like replacing one product with a better product. A competitor does not simply need to be good. It has to compete with an entire ecosystem. Nowhere is that ecosystem clearer than in global trading. Suppose a South Korean company sells electronics to a business in Brazil. Neither company is American. The buyer uses Brazilian reais. The seller operates in Korean won. You might expect them to deal directly in those two currencies. Sometimes they can, but international finance has historically made it extremely convenient to use the dollar as an intermediary. Convert crassid reais into dollars, then dollars into won. Why? Because dollar markets are exceptionally deep, liquid, and widely available. Liquidity sounds like financial jargon, but the idea is simple. A liquid market is one where huge amounts of something can be bought and sold quickly, without dramatically changing the price. For global businesses moving millions or billions, that matters enormously. The easier it is to trade a currency, the more useful that your currency becomes, and the more useful it becomes, the more people trade it. Another loop. In 2025, the global over-the-counter foreign exchange market was handling roughly $9.5 trillion of transactions. Per Dalton Y, the dollar remained involved in almost 9 out of every 10 trades. London, interestingly for UK viewers, remained the world's largest foreign exchange trading center, with the United States second, but currency trading is only one layer. Now imagine a company in another country, buying materials internationally. The company may earn revenue in its local currency, while receiving invoices in dollars. If its currency weakens against the dollar, its costs can rise, even when the seller never changes the dollar price bascom. That is where the dollar stops feeling like an abstract subject for economists. It enters ordinary life. Suppose an imported component costs $100. At one exchange rate, that might cost the buyer 80 units of its local currency. But after the local currency weakens, the same $100 component might cost 95. Nothing changed at the factory producing it. Nothing changed on the invoice. The exchange rate alone increased the local cost. The business now has choices: accept a smaller profit, raise prices, cut spending, delay hiring, or find a cheaper supplier. Eventually, financial pressure that began in a currency market can reach workers and consumers, and this effect becomes even more serious when debt is involved. Picture a fictional company that earns most of its money in its home currency, but borrows $10 million US. At first, the loan looks manageable. Then the local currency falls sharply against the dollar. The company still owes $10 million. But now it needs far more local currency to buy those dollars and make its payments. It's effectively become heavier, without the dollar value of the debt increasing at all. This is called currency mismatch. And it helps explain why the movements in the dollar can create financial stress far beyond America. The dollar remains deeply embedded in international banking. Federal Reserve analysis, using global banking data, has put the dollar at roughly 55% of international and foreign currency banking claims, and about 60% of comparable liabilities. Foreign currency debt issuance has also been heavily dollar-denominated. Now, something else starts to make sense. Why can a decision by the Federal Reserve matter to a company that has never sold a product in America? Because If global borrowing, lending and investment are heavily connected to dollars, then the price of dollars matters internationally. When U.S. interest rates rise, dollar borrowing can become more expensive. Investors may reconsider where they want to keep capital. Exchange rates can move. Financial conditions can tighten. Countries with large dollar obligations may feel pressure. This does not mean the Federal Reserve directly controls British mortgage rates, European policy, or another country's economy. The Bank of England, the European Central Bank, and other central banks make their own decisions, but those decisions are made inside a global financial system where the dollar has enormous weight. And the connection becomes most obvious during a crisis. When markets panic, investors usually do not ask only, "What can make me the highest return?" They ask a more basic question. Where can I put enormous amounts of money and still be confident that I can get it back? This brings us to one of America's most powerful financial assets: the U.S. Treasury market. When the American government borrows money, it issues Treasury securities. For investors and central banks, these securities provide something extremely valuable: a huge market where enormous sums can be stored and traded. As of the first quarter of 2025, foreign investors held around $9 trillion of marketable U.S. Treasury securities, according to Federal Reserve analysis. That included both private investors and official institutions. $9 trillion is not merely an investment position. It is infrastructure. Imagine you manage the reserves of a national central bank. You are responsible for tens or hundreds of billions. You cannot treat that money like a personal investment account. You need assets with scale. You need markets that trade constantly. You need confidence that when you need cash, someone will be there to buy. You need legal and institutional structures that global investors understand. And you need enough available assets to absorb huge transactions. That dramatically narrows your choices. This is one reason predictions of an overnight end to dollar dominance often miss the hardest part of the problem. The question is not simply, can another country create a currency? Of course it can. The question is, can it create everything that global institutions expect to exist around that currency? Deep bond markets, open financial markets, relayable settlement systems, large banking networks, global acceptance, liquidity during stress, enough investable assets, and decades of accumulated trust. Those are much harder to manufacture. Now we reach one of the most misunderstood parts of the story: oil. You may have heard a simplified explanation that the dollar rules the world because oil is priced in dollars, and that one so-called petrodollar arrangement somehow forces every country to keep using American currency. Oil pricing absolutely helped reinforce international demand for dollars. Commodity markets matter, but treating oil as the single secret behind dollar dominance gets the cause and effect backward. The dollar is powerful because an entire global financial network uses it. Oil is one important part of that network, not the whole machine. Even if a growing number of individual trades are settled in other currencies, the bigger question remains: what happens to reserves, banking, borrowing, securities markets, hedging, investment, and foreign exchange liquidity? One headline about a non-dollar oil transaction does not automatically dismantle decades of financial infrastructure, and that distinction matters because dramatic predictions about the dollar have become extremely profitable content online. The dollar is finished. The dollar will collapse next year. Countries are abandoning America. Those claims create attention because they turn a gradual financial shift into an emergency. Reality is less dramatic and much more useful. The dollar's share of global reserves has declined over the long term. Federal Reserve data show it was around 72% in 2001. By the first quarter of 2026, IMF data placed it a little above 57%. That decline is real, but a decline in market share is not the same thing as losing dominance. The euro remains a distant second at around 1/5 of allocated reserves, while reserve managers have gradually diversified into several other currencies and assets. Think of a company with 72% of a market falling to 57%. It has clearly lost share, but if its closest rival has around 20%, calling the leader irrelevant would be absurd. That is, roughly the distinction. Many dollar collapse discussions ignore, diversification is happening, replacement is a much higher bar. And each potential alternative comes with trade-offs. The euro represents a massive economic area and is already the second most important reserve currency, but Europe does not offer a single government bond market identical in structure and scale to the US Treasury market. China is one of the largest economies in the world, and the renminbi has become more important in international finance. But capital controls and differences in market openness affect how freely global investors can move very large amounts of money. Gold is nobody's liability and has remained important to central banks. But gold cannot perform every function that a modern global banking currency performs. And then there is cryptocurrency. At first glance, crypto appears to threaten the old system completely. A borderless digital asset does not need a central bank. A payment can cross countries without physical dollar notes, but the twist is that one of crypto's fastest-growing ideas has been the stablecoin, a digital token designed to track the value of a traditional currency. And many of the largest stablecoins are linked to the US dollar, so a technology built partly around escaping traditional finance may, in some circumstances, extend the dollar into digital markets rather than eliminate it. Federal Reserve researchers have already noted the growing international use of dollar-linked stablecoins alongside traditional dollar banknotes. That is the deeper pattern. Dollar dominance keeps adapting. First, gold convertibility helped support it. Then deep financial markets supported it after gold convertibility ended. Global banking expanded it. International debt reinforced it. Digital finance may now create another channel. The form changes, the network survives, and now we arrive at the biggest payoff. The dollar's greatest advantage is not that everyone loves America. It is that everyone expects everyone else to keep using the dollar. That expectation may sound psychological, but financially, it is extremely powerful. A central bank wants dollars, partly because businesses need dollars. Businesses need dollars partly because banks provide dollar financing. Banks provide dollar financing, partly because investors demand dollar assets. Investors demand dollar assets partly because Treasury and other dollar markets are deep and liquid. Those markets are deep and liquid partly because so many people already use them. There is no single switch. There are millions of incentives all pointing toward the same system. This is why global currency power can survive political disagreements. A government can dislike US policy and still hold dollar assets. A company can compete aggressively with American firms and still borrow in dollars. A country can publicly support a more diversified monetary system while its banks continue using dollars because their customers need them. Economics does not always follow political emotion. Sometimes infrastructure wins. But America receives real advantages from sitting at the center of that infrastructure. Global demand for dollar assets creates a vast pool of buyers for US securities. The United States borrows in its own currency. Foreign demand for dollar banknotes is also remarkable. Federal Reserve staff estimated that more than $1 trillion of physical US currency was held outside the United States in early 2025. Roughly half of all dollar banknotes then outstanding. There is also geopolitical power. When large parts of global finance pass through dollar markets and institutions connected to the American financial system, the United States can have significant leverage through financial sanctions and restrictions. That power, however, creates a paradox. The more aggressively financial infrastructure is used as a strategic tool, the more incentive some governments may have to search for alternatives. Does not mean alternatives can be built quickly. But it helps explain why countries discuss reserve diversification, alternative payment systems, and greater use of local currencies. The dollar's power can encourage the very efforts designed to reduce that power. There is another cost Americans sometimes forget. A reserve currency is not a free money machine. When the dollar becomes very strong, U.S. exports can become more expensive for foreign buyers. American manufacturers competing internationally may feel pressure. Foreign earnings of U.S. multinational companies can translate into fewer dollars. Tourists visiting America may find the country more expensive. Meanwhile, Americans traveling abroad can gain purchasing power. The same currency movement creates winners and losers. That is why strong dollar equals good, and weak dollar equals bad, are both oversimplifications. The answer depends on who you are, what you own, what you earn, what you owe and where you spend. For a UK viewer, the same principle matters. You may earn pounds and never deliberately invest in currencies. But your financial life can still contain dollar exposure. A global equity fund may own US companies, your pension may hold American assets. Businesses you buy from may import products priced in dollars. Energy and commodity markets can transmit exchange rate changes through costs. A British company may earn revenue in pounds while buying components or software contracts linked to dollars. Currency exposure can be hidden inside ordinary decisions. And that leads to a much more useful question. Then, when will the dollar collapse? Ask instead, where does currency risk exist in my own financial life? If you borrow in the same currency in which you earn most of your income, currency movements usually matter less to your ability to repay that debt. If your income is in pounds but your debt is in dollars, you have created another variable. If your savings are globally invested, exchange rates can raise or reduce the value of overseas assets when measured in your home currency. If your business depends heavily on imported goods, currency changes may affect your margins. You do not need to become a foreign exchange trader. You need to know where the exposure sits. And there is a second lesson. Do not build a financial plan around dramatic predictions of monetary collapse. Currencies change, reserve shares change, political relationships change, markets evolve, but nobody knows the exact path in advance. Selling everything because somebody claims the dollar will disappear next year. Analysis. It is speculation. The smarter approach is more boring. Diversify intelligently, understand what you own, understand what you owe. Match short-term money to short-term needs. Be careful about taking debt in a currency different from the currency of your income. And when you hear claims that a new currency, gold, crypto, or a geopolitical alliance, is about to destroy the dollar overnight, ask one question: what exactly is replacing the network? Not just the currency, the network. Where will central banks hold trillions? Where will global banks obtain liquidity? What assets will absorb enormous flows during a crisis? What currency will companies use for international debt? What will businesses voice in? What will traders use as the bridge between less liquid currencies? If those questions do not have clear answers, the replacement story is incomplete. That does not mean the dollar will dominate forever. No currency has a permanent right to the center of the global financial system. Economic power changes, technology changes, government debt matters, political institutions matter. Fiscal credibility matters, competitors develop, and the dollar's gradual decline in reserve share is evidence that diversification is already occurring. But reserve currencies tend to be displaced through structural change. Not because of one viral headline. The dollar's position was built over generations. Any true replacement would probably require something equally deep. A rival would need more than political support. It would need trust, liquidity scale, open markets, investable assets, reliable institutions, global banking connections, and millions of businesses and investors deciding that switching is worth the cost. Until then, the most extraordinary thing about the dollar is not the green paper itself. It is the invisible web surrounding it. A worker in Britain can be affected by it without holding it. A company in Asia can depend on it without selling anything to America. A government can criticize it while keeping billions of reserves in it. A bank can operate on another continent while still needing access to dollar funding when markets become stressed. And that is why the dollar appears to rule the world without actually ruling it. And there is no global law forcing everyone to participate. The system works because participation is useful. And participation makes the system even more useful for everyone who comes next. That may eventually change, but if it does, the signal will not be one country making one announcement. It will be the slow breaking of several links at once. Reserves, trade, banking, debt, liquidity and trust. Until that happens, the dollar's real strength remains almost invisible, not a secret agreement, not a single commodity, not a piece of paper. A network, and in modern finance, the strongest network can be more powerful than the strongest currency. But there is one final layer to this story. And it may be the most important one for ordinary people. Because when we talk about reserve currencies, central banks, treasury markets, and global trade, it is easy to imagine that this is a game played only by governments and billion-dollar institutions. It is not. The consequences eventually reach household money. Imagine a British family planning a holiday in Florida. If the pound weakens against the dollar, the same hotel room, restaurant meal, or rental car suddenly costs more in pounds. Nothing in America necessarily became more expensive. The exchange rate changed the family's purchasing power. Now reverse it. Imagine an American tourist traveling through Britain while the dollar is unusually strong against the pound. The same hotel, train ticket, and restaurant bill can feel cheaper when converted back into dollars. One currency movement, two completely different experiences. But travel is the easy example. The deeper effects often arrive through prices. A company importing materials may pay more when its home currency weakens against the dollar. An airline buying fuel or aircraft may face higher costs. A manufacturer using imported components may see margins compressed. A retailer may eventually pass some of those costs to customers. This is one reason exchange rates can quietly influence inflation. Not every price rise comes from currency movements, but currency movements can change the cost of imported goods, especially in economies that depend heavily on international trade. And this creates another important connection. When inflation is high, central banks may raise interest rates. Higher interest rates affect mortgages, business loans, savings accounts, bonds, and investment valuations. So a chain that begins in global currency markets can eventually arrive in something as ordinary as a monthly mortgage payment. That does not mean every mortgage increase is caused by the dollar. Financial systems are far more complicated than that. But it shows why global money cannot be completely separated from personal money. The world's financial system is connected. Sometimes those connections are visible, sometimes they are buried several layers deep. And the dollar sits near the center of many of those layers. There is also a psychological effect. When investors become nervous, they often move toward assets they consider safer or easier to sell. That behavior can strengthen the dollar during certain periods of market stress. And when the dollar strengthens rapidly, countries and companies with dollar debts can come under pressure at exactly the wrong moment. Imagine owing someone $100. When your currency is strong, buying those $100 is easy. Then a crisis hits, your currency falls, your revenue slows, investors become nervous, and suddenly everyone who owes dollars is trying to buy dollars at the same time. Demand rises just as financial conditions are becoming more difficult. That can create a dangerous feedback loop. A stronger dollar makes the debt harder to repay. The harder the debt becomes to repay, the more nervous investors become. Nervous investors may move toward dollars and highly liquid assets. And the dollar can become even stronger. This is why dollar shortages during financial crises can become a global problem rather than simply an American problem. And it explains something that sounds strange at first. During major periods of financial stress, foreign central banks may need access to dollars even though they can create their own domestic currencies. A central bank can create pounds, euros, yen, or another domestic currency. But it cannot simply print US dollars. If its banks or companies desperately need dollars, somebody has to provide them. This is where central bank swap lines can become important. In simple terms, the Federal Reserve can temporarily exchange dollars with certain foreign central banks, allowing those central banks to provide dollar liquidity inside their own financial systems. that is an extraordinary demonstration of the dollar's role. The world has many central banks. But during periods of severe stress, access to the American currency can become part of global financial stability, and once again, this strengthens the network. Banks know dollar funding markets exist. Companies know dollar financing is widely available. Investors know there are deep markets for dollar assets. Central banks know mechanisms exist to obtain dollar liquidity during extreme conditions. Each layer gives the next layer confidence. But confidence is never permanent. This is where the future becomes interesting. For decades, economists, investors, and governments have debated what could eventually weaken the dollar's position. One possibility is simple diversification. Central banks do not need to abandon the dollar completely. They can gradually hold more euros, gold, renminbi, yen, sterling, or other assets. That process can reduce the dollar's share without creating a dramatic collapse. Think of it like an investor who once kept 70% of a portfolio in one asset and gradually reduces that position to 55%. The asset has become less dominant, but it has not disappeared. Another possibility is the growth of regional trade networks. Countries may increasingly settle transactions directly in their own currencies. If a Chinese company buys from a Brazilian company, perhaps they decide they do not need the dollar for that particular transaction. If enough trade begins happening this way, the dollar's role in some areas could gradually weaken. But there is still a catch. Settling one trade without dollars is much easier than replacing dollar-based global finance. A company might invoice a transaction in another currency, while its bank still relies on dollar funding. A central bank might increase its gold holdings, while keeping most liquid reserves in dollar assets. A government might promote local currency trades while its corporations continue issuing dollar debt. That is why individual announcements can sound more revolutionary than they actually are. The real transformation would require many systems to change together: trade, debt, banking, reserves, payments, financial market liquidity, and trust. Now, consider another potential challenger: central bank digital currencies. Several countries have explored or developed digital forms of sovereign money. In theory, digital settlement could make cross-border transactions faster and reduce dependence on traditional banking infrastructure. That could alter parts of the international monetary system, but technology alone does not automatically create trust. A digital currency can move instantly and still be unattractive as a reserve asset. Speed is useful, but central banks also care about legal certainty, market depth, political stability, convertibility, and the ability to move enormous amounts of money without disrupting prices. A faster railway does not help much if people do not trust the destination, and that leads to the central question: what could genuinely dethrone the dollar? Probably not one invention, probably not one agreement, probably not one geopolitical alliance. The biggest threat to the dollar may ultimately come from the same thing that created its power in the first place: confidence. If global investors gradually lose confidence in the stability, openness, institutions, or long-term financial management of the United States, the network effect could begin working in reverse. Central banks diversify. Investors demand alternative. Businesses borrow in other currencies. Financial markets deepen elsewhere. More trade is settled outside dollars. And every new alternative makes the next alternative easier to use. Remember the language analogy. If almost everyone speaks one common language, learning another language seems unnecessary, but if enough people begin using a second language, the advantage of the first one slowly shrinks. The transition could begin almost invisibly. Not with a collapse, with convenience. And that is why America cannot take reserve currency status for granted. The dollar's global position is an advantage. But maintaining that advantage requires credibility. People need confidence that American financial markets will remain open. They need confidence that contracts will be respected. They need confidence in institutions. They need access to large quantities of high-quality financial assets. And they need to believe that holding dollars tomorrow will still be useful to everyone else. This also explains why U.S. government debt creates such a strange debate. On one side, the enormous treasury market is part of what makes the dollar so useful. Global investors need large quantities of liquid dollar assets. U.S. government debt helps provide those assets. But excessive fiscal problems could eventually weaken confidence if investors begin questioning long-term financial stability. So the same system contains a tension. The world wants large quantities of dollar assets, but the credibility of those assets must remain strong. That balance matters. And it gives us a better way to think about financial power. Real financial power is not simply having the biggest pile of money. It is having other people organize their decisions around your money. A small business owner in another country may check the dollar before ordering inventory. A central bank may watch U.S. Treasury yields before changing its reserve strategy. A global investor may watch the Federal Reserve before reallocating capital. An airline may hedge future dollar expenses. A commodity producer may calculate revenue in dollars. A government may worry about dollar debt during a currency crisis. The dollar influences decisions before any physical dollar changes hands. That is power. But it is also responsibility, because when the currency at the center of the system moves sharply, the consequences can spread through countries with very different economic conditions. A policy decision that makes sense for the United States may create uncomfortable side effects elsewhere. The Federal Reserve's job is primarily to pursue its domestic mandate. It does not set interest rates to solve every foreign country's problems, yet because the dollar has global importance, U.S. monetary policy inevitably has international consequences. That is one of the contradictions built into the modern system. A national currency performs an international job. America controls the currency. The world uses the network, and the interests of those two groups will not always be perfectly aligned. For investors, this creates another lesson. Owning international assets is not only a bet on the asset itself. Sometimes it is also a currency exposure. Imagine a UK investor buys shares in an American company. The company performs well. Its stock rises 10%. But during the same period, the dollar falls significantly against the pound. When the investor converts the investment back into pounds, part of the stock market gain may disappear. Now imagine the opposite. The US stock barely moves, but the dollar strengthens against sterling. The UK investor could still see the value of the investment rise when measured in pounds. The same principle applies to an American investor owning British, European, or Japanese assets. Investment returns and currency movements can interact. This does not mean you should constantly trade currencies. For most long-term investors, trying to predict exchange rates can create more problems than it solves. But it does mean you should understand what your portfolio actually contains. A globally diversified fund may expose you to companies earning revenue in dozens of currencies. A multinational company listed in New York may earn much of its revenue outside the United States. A British company listed in London may make much of its money overseas. The label on the stock exchange does not tell you the entire economic story. Money is global long before it reaches your investment account, and this is why understanding the dollar is not about predicting whether it will rise tomorrow. It is about understanding the architecture behind the financial decisions you already make. Your mortgage, your pension, your investment fund, your business costs, your holiday, your imported products, your government's borrowing environment, your currency's purchasing power. All of them can connect, directly or indirectly, to the same global system. So the next time you hear that the dollar is about to disappear, ask what would need to happen first. Would central banks need to move hundreds of billions of reserves? Would companies need to refinance debts into different currencies? Would banks need new sources of international liquidity? Would investors need alternative markets large enough to absorb enormous capital flows? Would commodity traders need new pricing systems? Would governments trust the legal and political structures behind the replacement? Would people around the world believe everyone else would use it too? That final question may be the hardest. Because money is partly a technology, But it is also a collective belief. A dollar bill has little physical value. A number in a bank account has even less. Its power comes from agreement. You accept it because you know somebody else will accept it. A business accepts it because suppliers will accept it. A bank holds it because borrowers need it. A central bank holds it because financial markets use it. Scale that belief across the planet, and you get something much larger than a currency. You get a monetary network, and networks are difficult to replace, precisely because they do not have one center that can simply be switched off. You would have to change millions of habits, millions of contracts, millions of financial relationships, one at a time. That is why the dollar can slowly lose ground and still remain dominant. It is why countries can search for alternatives while continuing to use it, and it is why predictions of both permanent dollar supremacy and immediate dollar collapse should be treated cautiously. The future will probably be more complicated than either extreme. The world may become more multipolar. The euro may remain important. China may increase the international use of the renminbi. Gold may continue playing a larger role in reserve diversification. Digital currencies may change how money moves. Regional payment systems may reduce the need for dollars in some transactions. But, even in that future, the dollar could remain the largest single piece of the system for a long time. Dominance does not require monopoly. It requires being the default option often enough that the network keeps reinforcing itself. And that may be the simplest explanation for one of the strangest facts in modern finance. The United States does not need to force every country to use the dollar. The system has created its own incentives. Banks use dollars because customers need them. Customers need dollars because markets use them. Markets use dollars because investors want them. Investors want them because they can easily trade them. And they can easily trade them because everyone else is already there. Round and round it goes, a financial circle powerful enough to influence governments, companies, markets and ordinary households. So when you see the green dollar sign on a screen, remember what it actually represents. Not just American money, a claim on the largest financial network in the world, a network built through history, strengthened by liquidity, protected by habit, supported by institutions, challenged by competitors, and ultimately held together by trust. The dollar does not secretly rule the world, because someone designed a hidden system of control. Its power is more subtle than that. The world built millions of financial roads, and for decades, an extraordinary number of those roads have led through the same currency. The real question is not whether those roads can change. They can. The question is how many new roads must be built before the world no longer needs the old ones. And that process may take years, decades, or perhaps something completely unexpected. For your own money, you do not need to predict that future perfectly. You need something more useful. Understand the risks you can control. Do not take reckless currency exposure you do not understand. Diversify rather than gamble on one dramatic prediction. Be cautious when somebody claims a complicated global system has one simple secret. And remember that long-term wealth is usually built by understanding systems, not by reacting emotionally to headlines. The dollar's story is ultimately a lesson about money itself. Money becomes powerful when people trust it. Trust becomes stronger when more people use it, and once enough people build their financial lives around the same system, changing that system becomes far harder than anyone expects. Subscribe to Wealth Tactics for smarter money decisions and practical strategies for building long-term wealth. Phosphorus to Wealth Tactics for smarter money and practical strategies for building long